Digital Assets for Investors. Chapter 5, Crypto Market Structure. Section 1, Crypto Exchanges. A crypto exchange is the main marketplace where most investors actually enter the digital asset market. Its core job is to bring buyers and sellers together so trades can happen efficiently. On some platforms, that also includes converting traditional money like dollars or euros into crypto, which is often the first step for a new investor. Exchanges also let people trade one digital asset for another, such as moving from Bitcoin into Ether or from a stable coin into a smaller token. As these buy and sell orders meet, the market begins to discover a price based on supply and demand. So when we talk about crypto market structure, exchanges are the starting point because they sit at the center of how trading happens. There are two broad exchange models in crypto, and the difference is mostly about who controls the trading system. A centralized exchange, or CEX, is run by a company that manages accounts, executes trades, and usually holds customer assets while they are on the platform. A decentralized exchange, or DEX, works through blockchain-based smart contracts instead of a traditional company-operated platform. Centralized exchanges usually emphasize convenience, speed, and a familiar user experience. Decentralized exchanges emphasize user control, direct wallet access, and transparent on-chain activity. Both can help you swap one asset for another, but the way the trade is processed, settled, and controlled is very different. Many investors begin with centralized exchanges because they are often the easiest on-ramp into crypto. These platforms usually have higher liquidity, which means it is easier to buy or sell without moving the price too much. They also tend to offer faster trade execution and simple interfaces that feel familiar to people who have used online brokerages or banking apps. For a beginner, that convenience matters, especially when depositing fiat currency for the first time. Centralized exchanges may also provide customer support, account recovery options, and straightforward funding methods like bank transfers or cards. In practice, a CEX often lowers the friction of getting started, even though that convenience comes with important trade-offs. The trade-off with a centralized exchange is that you are trusting the platform with a lot. In most cases, the exchange controls the private keys for assets held on the platform, which means it effectively controls access to those assets until you withdraw them. That creates dependency on the exchange's security, internal controls, and financial stability. If the platform is hacked, becomes insolvent, or pauses withdrawals, users may not be able to access their funds when they expect to. This is why the phrase, "not your keys, not your coins," is repeated so often in crypto. A centralized exchange can be convenient, but that convenience comes with custody risk that investors should take seriously. Decentralized exchanges appeal to investors who want to trade without handing custody to a company. Instead of depositing funds onto a platform, users connect their own wallets and trade directly through a protocol. That means the assets usually remain under the user's control throughout the process. DEXs also often provide access to a wider range of tokens, especially newer or more niche assets that may not be listed on major centralized exchanges. In many cases, the setup is lighter because you connect a wallet rather than opening a traditional account. For investors who value self-custody and direct on-chain access, a DEX can offer more control and less reliance on a single company. A decentralized exchange removes some centralized platform risk, but it does not remove risk overall. Instead, more responsibility shifts to the user and some new technical risks appear. Liquidity can be lower on certain DEX markets, so large trades may push the price and create more slippage. Transaction costs also depend on network conditions, which means gas fees can rise sharply when blockchains are congested. On top of that, users still face smart contract risk, wallet security risk, and transaction ordering issues such as front-running in some environments. So a DEX may reduce reliance on a company, but it asks the investor to manage more of the operational and technical complexity directly. Although both exchange types let you trade assets, the workflow behind the screen is different. On a centralized exchange, you usually create an account, often complete identity checks, deposit funds, and then trade through an order book managed by the platform's matching engine. On a decentralized exchange, you typically connect a compatible wallet and submit a swap through a smart contract. Centralized exchanges usually match buyers and sellers directly through bids and asks. Decentralized exchanges often rely on liquidity pools and automated market makers, where the price is determined by the pool structure rather than a traditional order book. From an investor's perspective, the goal is the same, but the mechanics, costs, and risks are not. What happens after a trade is just as important as what happens during it. On a centralized exchange, the platform usually updates your balance on its internal ledger, which can make settlement feel very fast because nothing necessarily moves on a public blockchain right away. But the asset generally remains under exchange custody until you withdraw it. On a decentralized exchange, settlement happens on-chain, and the resulting assets are typically delivered directly back to your wallet. That usually takes longer than an internal ledger update, but it gives public blockchain finality and keeps control with the user. So settlement affects both speed and who actually controls the asset after the trade is complete. Exchanges make money in several ways, and those fees directly shape your real trading cost. The most visible charge is the trading fee on each buy or sell, but that is only part of the picture. Many platforms also charge withdrawal fees when you move assets off the exchange, and some may charge for deposits or earn revenue from listing arrangements. Fee schedules often distinguish between makers and takers, with makers usually paying less because they add liquidity to the market. For an investor, this means the headline asset price is never the full story. The real cost of a trade is the market price plus spreads, fees, and any additional costs involved in moving assets where you want them. Evaluating an exchange means looking past branding and asking whether it fits your actual needs. Start with liquidity and spreads, because a low advertised fee does not help much if the market is thin and execution is poor. Then compare the full cost structure, including trading fees, withdrawal fees, and gas costs where relevant. Security matters too, so it is worth checking the platform's custody practices, incident history, and whether it offers safeguards like two-factor authentication or proof of reserves reporting. You should also confirm that the exchange supports the assets you want, works in your jurisdiction, and matches your comfort level with KYC and withdrawal limits. In practice, the best exchange is not simply the cheapest one, but the one that balances access, execution quality, and risk management. A practical comparison helps make these trade-offs real. If Maya uses a centralized exchange to buy crypto, the process may be quick and beginner-friendly. Fund the account, place the trade, and optionally withdraw the asset later to a personal wallet. But her total cost includes both the trading fee and, if she wants self-custody, the withdrawal fee. If she uses a decentralized exchange instead, she may avoid a separate withdrawal step because the asset lands in her wallet immediately after settlement. Even so, that route can introduce gas fees, slippage, and more personal responsibility for wallet safety. The economic goal is the same in both cases, but the workflow, frictions, and risks are clearly different. The biggest exchange mistakes usually come from ignoring trade-offs. One common error is leaving all funds on an exchange for convenience, even though custody concentration increases platform risk. Another is focusing only on the asset price while overlooking spreads, withdrawal fees, and gas, all of which affect what you actually pay. Investors also get into trouble by using market orders in thin markets, where even a modest trade can produce poor execution. And because crypto combines finance with internet infrastructure, operational mistakes matter too, including phishing sites, misunderstood KYC limits, and assumptions that a large platform must automatically be safe. The goal is not to avoid every exchange, but to understand the risks of the one you are using before you trade. Section 2. Liquidity and order books. Liquidity tells you how easy it is to trade an asset without pushing the price around too much. In the liquid market, buy and sell interest is strong enough that even a fairly large order can be absorbed with limited disruption. In an illiquid market, a much smaller order may move the price sharply because there are fewer resting orders available. That difference directly affects execution quality and trading cost. Better liquidity usually means tighter pricing, lower slippage, and more predictable fills. So before focusing on where you think the market is going, it helps to ask whether the market is actually easy to trade. Two of the simplest ways to judge liquidity are spread and depth. The spread is the gap between the best available bid and the best available ask, so it measures the immediate cost of crossing the market. Depth refers to how much buy and sell volume is available at different price levels, not just at the top, quote. A narrow spread is helpful, but it does not guarantee the market can absorb a larger order. Strong depth matters because it lets more size trade without forcing the price far away from where it started. In general, markets with narrow spreads and solid depth tend to be easier and cheaper to trade. An order book is the exchange's live list of outstanding buy and sell orders. On the bid side are buy orders, ranked from the highest price down, because buyers offering more are most competitive. On the ask side are sell orders, ranked from the lowest price up, because sellers willing to accept less are most competitive. The highest bid is called the best bid, and the lowest ask is called the best ask. The difference between those two prices is the bid-ask spread. Because traders are constantly adding, matching, and canceling orders, the order book is always changing, which is why it gives a live picture of current market interest rather than a fixed snapshot. Traders interact with the order book, mainly through limit orders and market orders, and that distinction matters. A limit order sets the maximum price you will pay or the minimum price you will accept, and if it does not match immediately, it can rest in the book. A market order does the opposite. It executes right away against the best available prices on the other side. Traders who place resting limit orders are called makers because they add liquidity to the market. Traders who submit orders that immediately trade against those resting orders are takers because they remove liquidity. Since makers help build the market, exchanges often reward them with lower fees than takers. The path a trade takes through the order book depends on both order type and available size at each price. If you place a limit order that does not immediately match an existing order, it enters the book and waits. The exchange continuously sorts bids and asks, so the best bid and best ask form the current quote. A market order, by contrast, trades straight into the opposite side of the book, filling first at the best available price. If the order is larger than the available volume at that level, it keeps moving to worse prices deeper in the book. That is why the top quote alone can be misleading when you are trading more than a very small amount. Slippage is the gap between the price you expected and the price you actually received. It often appears when a market order is large relative to the available depth near the top of the book. You may see an attractive best price on screen, but if there is not enough volume there, only part of your order fills at that level. The remaining size has to trade at worse prices deeper in the book, raising your average cost if you are buying or lowering your proceeds if you are selling. Deep books reduce this problem because they can absorb more size near the current quote. Shallow books increase execution risk because the visible top price does not represent what your whole order can necessarily get. A simple example makes both spread and execution easier to see. Suppose BTC trades with the best bid at 60,000 for 5 Bitcoin and the best ask at 60,010 for 3 Bitcoin. That means the spread is 10 USDT. If you submit a market order to buy 4 Bitcoin, only the first 3 can fill at 60,010, because that is all the size available at the top ask. The remaining 1 Bitcoin has to fill at the next ask, which is 60,020. Your average execution price becomes 60,012.5, not the best displayed ask, because your order had to move beyond the first level. Using that same example, we can measure slippage directly. If the buyer expected to get all 4 Bitcoin at 60,010, the actual average fill of 60,012.5 shows an extra cost of 2.5 USDT per Bitcoin. Across 4 Bitcoin, that adds up to 10 USDT of total slippage. On a small trade in a major market, that may not feel dramatic. But the lesson is important because slippage often scales up quickly as order size grows or liquidity weakens. What looks minor on a modest order can become a meaningful execution cost on a larger one. Depth charts are a visual summary of where orders are clustered across prices. Large clusters of buy orders can sometimes act like support because they suggest meaningful demand below the market. Heavy clusters of sell orders can sometimes act like resistance because they suggest supply above the market. Depth can also help you estimate how much size the market might absorb before price moves significantly. But these charts need to be read carefully because visible orders are not guaranteed to stay there. Traders can cancel or move orders before execution, and in some cases, visible size can even be used to mislead other participants. Before placing a trade, it helps to do a quick liquidity check rather than relying on the headline quote. A tight spread is useful, but it does not automatically mean the book has enough depth for your order size. Look at the volume sitting behind the best prices, not just the first line. Include maker and taker fees in your calculation, because low slippage can still be offset by high transaction costs. It is also worth remembering that liquidity can vary a lot from one exchange to another, even for the same asset pair. Good execution comes from comparing spread, depth, and likely slippage together, not from focusing on only one metric. Section 3. Market makers. Market makers play a central role in keeping trading continuous. Their basic job is to stand ready to buy and sell at the same time by posting both a bid and an ask. That adds liquidity to the market because other traders can transact against those quotes, instead of waiting for a natural buyer and seller to appear at the exact same moment. In thinner markets, this can reduce sudden price jumps and make trading smoother. Market making may be done by specialized firms, designated liquidity providers, or automated trading systems. However it is implemented, the purpose is the same. Keep the market functioning with more consistent two-sided quotes. The business model of market making is simple in concept, even if it is difficult in practice. A market maker tries to buy slightly lower at the bid and sell slightly higher at the ask, capturing the spread in between. If the bid is $50 and the ask is $50.05, the gross spread available is 5 cents per unit. That sounds small because it is small. The strategy depends on doing this repeatedly and at meaningful volume. And even that gross spread is not true profit yet because fees, inventory risk, and fast price moves can easily consume it. Market making is a continuous cycle rather than a single trade. The market maker watches prices, order flow, and book conditions, then posts limit orders on both sides of the market. Incoming market orders may hit one side or the other, leaving the maker with inventory to manage. If they buy more than they sell, they may need to adjust their quotes to encourage offsetting flow or hedge elsewhere. As the market moves, stale quotes become dangerous, so the maker reprices constantly. The goal is not just to earn spread, but to do it while controlling inventory and avoiding being caught at outdated prices. Two of the biggest risks in market making are inventory risk and adverse selection. Inventory risk appears when fills leave the maker holding a position that moves against them before they can unwind it. Adverse selection happens when a quote becomes stale and a faster or better informed trader trades against it just before the market moves. In both cases, the maker may still have technically earned the spread, but the price move afterward can more than erase that gain. One-sided fills make this especially dangerous because exposure builds up when the market is already shifting. That is why many small profitable trades can be wiped out by one sharp move or a series of poorly timed fills. Consider a simple ETH example. Suppose the mid price is $1,800 and a market maker quotes a bid at $17.9950 and an ask at $1,850 for 10 ETH on each side. A seller hits the bid for 5 ETH, so the market maker buys those 5 at $17.9950 and is now long inventory. If the maker can then sell that inventory at $1,830, the gross profit is 80 cents per ETH. On 5 ETH, that becomes $4 before fees. The example shows an important detail. The maker did not capture the entire $1 spread because the exit happened before the original ask and involved some inventory management. That same ETH position can go wrong very quickly. If the market maker buys 5 ETH at $17.9950 and the market drops to $17.98 before they can exit, the position is already underwater by $1.50 per ETH. Across 5 ETH, that is a $7.50 unrealized loss. Notice how easily that loss can exceed the small spread the maker hoped to earn. This is why quoted spread alone is not a good measure of safety. In market making, risk control, quote updates, and position limits matter more than the attractive appearance of a two-sided market. Retail traders can imitate some market making behavior, but they usually do not compete on equal terms with professional firms. Professionals often have faster infrastructure, automated quoting systems, and better connectivity to exchanges. They may also hedge inventory across multiple venues, which helps them stay balanced and reduce exposure. Retail traders are typically slower, face higher relative fees, and have fewer tools to manage risk across markets. That does not mean retail traders cannot provide liquidity in some settings. It means the same basic strategy operates under very different conditions depending on speed, cost structure, and access to hedging tools. Most market-making mistakes come from underestimating how fast conditions can change. If spreads are set too wide, almost nothing fills and the strategy loses purpose. If inventory builds up during a fast move and the trader does not react, losses can grow faster than expected. Static quotes are also dangerous because a quote that looked reasonable a moment ago may be stale as the market shifts. Fees, rebates, and event risk matter too, since a trade that looks profitable before costs may not be profitable after them. Perhaps most important, not every fill is a good fill, because some fills are a sign that the market knows something your quote has not yet reflected. The practical takeaway is that market makers help make trading easier for everyone else by adding liquidity and narrowing gaps between buyers and sellers. Their edge comes from collecting many small spreads over time, not from predicting huge market moves. But the real challenge is managing inventory risk and adverse selection while keeping quotes current. Good market making requires speed, constant updates, and clear limits on how much exposure is acceptable. And when markets become unstable, even skilled participants may widen quotes or step back entirely. So market making supports orderly trading, but it is far more demanding than simply posting a bid and an ask. Section 4. Volatility. Volatility describes how much price moves around over time. If prices make large and frequent swings, volatility is high. If price changes are smaller and steadier, volatility is lower. Importantly, volatility does not tell you whether the market is going up or down. A market can rise with low volatility, fall with low volatility, or move sideways while still being highly volatile if the swings are big enough. For investors, volatility is really a measure of instability or variation, not direction. That distinction matters because a strong trend and a noisy market are not the same thing. Crypto markets are often more volatile because they can reprice at any hour, and under changing liquidity conditions. Trading happens 24 hours a day, 7 days a week, so there is no formal market close that pauses price discovery. Liquidity can also vary a lot across exchanges and time zones, which means market depth may be strong at one moment and much thinner later. Sentiment in crypto can shift quickly in response to regulation, macro news, protocol events, or exchange problems. And because some markets are still relatively thin, a large trade can move price sharply. All of this makes crypto especially responsive and often over-responsive to new information and order flow. Historical and implied volatility answer different questions. Historical volatility looks backward and asks how much the asset has actually moved over a chosen time window. It is usually calculated from past returns, so it is a measure of realized variation. Implied volatility looks forward and reflects how much movement the options market is pricing in for the future. It is not observed directly in the asset's price history, but inferred from option prices. The two are related, but they are not interchangeable, because one describes what has happened and the other reflects what the market expects might happen. In practice, volatility measurement starts with returns over time, such as minute by minute, hourly, or daily changes. If those returns are tightly clustered, historical volatility is lower. If they are widely dispersed, historical volatility is higher because price is moving around more aggressively. Implied volatility comes from options prices, which embed the market's expectation of future movement rather than just past movement. Another important idea is that volatility tends to shift in regimes. Markets can stay calm for a period, then abruptly become turbulent, which means risk settings that worked last month may no longer fit current conditions. Volatility matters for trading because it creates both opportunity and difficulty at the same time. Larger price swings can increase profit potential because there is more movement to capture. But those same swings also make stops easier to hit, even when your broader trade idea is still intact. Sharpened trade wicks can force traders out early, and fast markets can worsen execution by increasing spread and slippage. In calmer conditions, trade management is often more forgiving. In volatile conditions, the market may move enough to reward you or hurt you much faster than expected. Volatility becomes especially dangerous when liquidity is thin. In a deep market, many resting orders can absorb buying or selling pressure without causing much disruption. In a thin market, the same order may sweep through multiple price levels and create a much larger move. That often goes hand in hand with wider spreads, which raise trading costs before slippage is even considered. Low liquidity periods, such as off hours or stressed conditions, can therefore be more unstable than usual. So when volatility rises, it is not only the chart that matters, but also the quality of the order book behind it. Leverage magnifies volatility by turning a modest move in the asset into a much larger change in your account equity. A 5% move in the underlying asset may sound manageable on its own, but at 10 times leverage, that same adverse move can translate into roughly a 50% loss on collateral before considering fees and liquidation mechanics. As leverage rises, the margin for error becomes very small. A move that would be uncomfortable in an unleveraged position can become severe in a leveraged one. That is why high volatility and high leverage together are such a dangerous combination. Suppose each is trading at $2,000 and its recent daily moves have ranged from negative 3.5% to positive 6%. Even without complex math, that wide spread tells you the market has been moving around a lot. If the average daily move is about 2.6%, that already suggests meaningful realized volatility. If options are implying daily movement closer to 6.3%, the market is expecting even more action ahead. At 5 times leverage, a 6.3% adverse move would translate into about a 31.5% loss on your collateral. The lesson is simple. When both realized and implied volatility are elevated, leverage becomes much less forgiving. Risk management should adapt to the volatility regime, rather than stay fixed in every market. When volatility rises, reducing leverage is usually one of the first adjustments to make. Smaller position sizes help too, because they lower the dollar impact of sharp swings. Stops may need to sit farther from entry in turbulent markets, so normal noise does not knock you out immediately. In calmer markets, tighter stops and slightly larger size may be more appropriate because price behavior is less erratic. The key idea is that a trading plan should breathe with the market instead of assuming all conditions are the same. A practical way to assess volatility is average true range, or ATR. ATR starts by looking at each period's high, low, and previous close to calculate the true range, which captures how much price really moved. You do that for a series of periods, often 20, and then average the values. The result gives a simple estimate of typical movement over your chosen time frame. That can help with position sizing, stop placement, and deciding whether a market has become unusually active. A useful habit is to ask how your plan changes if ATR doubles, because that question forces you to prepare for changing conditions rather than assume stability. Many volatility mistakes come from treating unstable conditions as if they were normal. One common error is confusing volatility with direction, as if a choppy market must still be trending cleanly. Another is using the same fixed stop in every environment, even when normal price noise has expanded. Traders also get into trouble by adding too much leverage during fast markets, where a small move can quickly become a major loss. And execution quality matters, because thin liquidity can distort fills far away from the expected price. In other words, volatile markets do not just change risk on paper, they change how trades actually behave in practice. Section 5. Trading pairs. A trading pair tells you which two assets are being exchanged in a specific market. When you see something like BTC/USDT, that means there is a market where Bitcoin trades directly against Tether. The pair represents one exchange relationship between those two assets, not a universal price in isolation. Trading pairs let investors move from one digital asset to another without returning to fiat currency each time. That flexibility is one reason crypto markets can support many routes between assets. Understanding the pair is the first step to understanding what you are actually buying, selling, and paying with. The order of the symbols in a trading pair matters because each side has a different role. The first asset is the base currency, which is the asset being bought or sold. The second asset is the quote currency, which is the asset used to measure the price of the base. In BTC/USDT, Bitcoin is the base and USDT is the quote. If the pair trades at 60,000, that means one Bitcoin costs 60,000 USDT. So when reading any pair, Always start by identifying which asset is the thing being priced and which asset is doing the pricing. A pair price always tells you the value of one unit of the base currency in units of the quote currency. If ETH/BTC is priced at 0.06, that means one Ether costs 0.06 Bitcoin. If BTC/USDT is 68,000, that means one Bitcoin costs 68,000 USDT. This shows why pair prices are relative rather than absolute. The same asset can have a different looking price depending on what it is being measured against. It also explains why BTC/USDT and USDT/BTC are not just mirror labels, but different ways of expressing a market relationship. Exchanges use trading pairs because they allow many assets to connect without forcing every trade due dollars or euros. A trader can move from crypto into a stablecoin, from one crypto into another, or through an intermediate market if that route is more liquid. For example, someone might sell ETH into USDT and then use USDT to buy BTC rather than converting through fiat. This structure makes markets more flexible and often more efficient. It also supports global trading because stablecoins and crypto pairs can function across venues that do not all share the same fiat rails. In effect, pairs create a network of possible paths between assets. Once you choose a pair, your order direction determines what leaves your account and what enters it. In BTC/USDT, buying means you spend USDT to receive BTC. Selling means you deliver BTC and receive USDT in return. The order book for that pair shows bids and asks specifically for Bitcoin against USDT, so it tells you what buyers are willing to pay and sellers are willing to accept. That is why choosing the correct pair matters before you even think about execution. If you misunderstand the pair, you can misunderstand the entire trade. Pair choice affects cost, because not all markets for the same asset are equally liquid. One route may have tighter spreads, deeper order books, and more reliable execution, while another route to the same asset may be thin and expensive. Active pairs usually attract more volume, which tends to reduce slippage and narrow the spread. Thin pairs can do the opposite, making execution less predictable, even if the display price looks similar at first glance. This means two investors trying to reach the same final asset can end up with different results depending on the pair they use. Good pair selection is really a form of execution management. A direct pair lets you trade one asset straight into another, such as ETH/BTC. A cross rate estimates that exchange indirectly through two markets that share a common asset, often a stablecoin like USDT. So instead of trading ETH directly for BTC, you might sell ETH for USDT and then use USDT to buy BTC. Sometimes that indirect route is actually cheaper if the two USDT markets are much more liquid than the direct pair, but that depends on spreads, fees, and available depth in each leg. The important point is that the shortest route is not always the best execution route. A simple cross-rate example makes this concrete. Suppose ALSAL/USDT is 20.5 and Matic/USDT is 1.25. If there is no direct SAL/Matic market, you can estimate the exchange by selling one SAL for 20.5 USDT and then using that USDT to buy Matic. Dividing 20.5 by 1.25 gives 16.4 Matic. So one cell is roughly worth 16.4 Matic through those two USDT pairs. That is only an estimate before fees and slippage, but it shows how common quote assets can link markets together. The implied cross rate is just a starting estimate, not a guaranteed final result. In real trading, each leg of the route has its own bid-ask spread, and each trade may also incur fees. If the order books are thin, slippage can appear on either leg and reduce the amount you finally receive. Two-step routes also introduce more complexity, because you are relying on two executions rather than one. If prices move while you are completing the route, the final outcome may differ from the simple estimate. So when comparing routes, think in terms of total execution quality, not just the clean arithmetic of the cross rate. Many pair-related mistakes come from reading the notation incorrectly or ignoring market quality. A common error is forgetting that pair order changes meaning, so BTC/USD and USD/BTC are not the same thing. Another is treating pair prices as if they were absolute values instead of relative exchange rates. Traders also run into trouble by using thin pairs without checking spread and depth first. It is worth remembering too that stablecoins are not exactly the same thing as fiat, even if they are designed to track it closely. And whenever a trade requires multiple steps, you should count the extra spreads, fees, and slippage before assuming the route is efficient.